Hey everyone, Keshav here. Welcome to this week's episode of Investing for Generational Wealth. Today, here with me, I have the honor of welcoming Dr. Eric Tait. And Eric, if you could start off by introducing yourself, your experience, and we can get right into our topic.
Yeah, not a problem. And so if you want, I can either kind of do it because if it's video, I can absolutely do it through kind of a presentation style, or I can just talk about it, whatever's easiest for you and however you would like to do this for your audience from that point. So you kind of tell me, and we can go forward from there.
Whichever one you feel more comfortable with. We'll be uploading both the video and the podcast,
Okay.
audio.
So I'll do a quick screen share. We can just go over because I think it's easier to walk through what kind of we do and it should probably take more than 3 to 5 minutes at most, if even that. So I'm Dr. Eric Tait. I am president and founder of Vernonville Asset Management, kind of where our motto is kind of income beyond Wall Street. And so just a little bit of my background. I'm a dual degree MD MBA from Baylor College of Medicine and Rice University. So I still am a practicing internist overseeing an insulin infusion clinic here in the Houston market. So I don't have to be in there every day. I oversee nurse practitioners and others. So I'm not day-to-day in there anymore. And I spend most of my time kind of in the investment world. And so at Vernonville Asset Management, we do kind of 3 major things. Real estate for current cash flow, and we do a little bit of development either for sale or to hold for cash flow. We do private debt/notes. And we do that with we've done that with operating business historically. And then we do some angel investing, and then we professionalized it with a sister company on the venture side. So just from an overview standpoint, in terms of history, I still own dozens of single family homes. I'm still a neighborhood rent man. We don't bring investors into single family homes. I'm also not adding any single family homes, but we've got dozens of them still. So, I know how to run real estate from kind of the lowest level of residential there is. We've owned everything from 10 to 97 unit apartment complexes where I was the managing GC, underwrote everything, hired people, pulled 11 sewer lines out of the ground, C-class apartments, been there, done that. Only thing I haven't done is replace a swamp cooler. We pivoted to some international projects. So we helped to build the Hilton Hotel in Belize on Ambergris Key. We own some coffee plantations in Panama as well. We do like agricultural investments. So we've been hunting wine vineyards for a while as well. We like to own things that human beings have been consuming from before there were actual governments, just from a diversification standpoint. And then we're heavily in commercial real estate these days, kind of from 2018 on, pivoted out of multifamily personally and went into kind of the triple net space just because we saw some things on the horizon around inflation and especially here in Texas, the pushing through of property taxes and things of that nature. So we own a lot of retail. So this is just kind of a quick overview. Not going to go through each particular project unless we want to, but just to show that we have a lot of experience in the space. We're blessed in this market to have about a 95% occupancy rate for retail. And almost all of these projects are at least 90% occupied, if not more. And so many of these are all across Houston. Houston, I consider more to be a region than a city. So you've got 60 to 70 miles of driving between one spot to the other. And so all of these things you see now, we currently own on the retail side. This was a project we closed towards the end of last year. This is a smaller redevelopment project we're undertaking as well. And then on the light industrial side, we've done full cycle on a few projects in the Houston market. And so these are what people call contractor garages or light industrial or flex industrial. We like that a lot. We got in there fairly early. These were like 2018 vintage projects that we went full cycle on. This was a hybrid project. We buy portfolios when we get a chance. There's some cold storage in here as well. This is kind of a Class A project that has an interesting story behind it. Business park as well. Business park and self-storage. And this is a warehouse deal we closed literally right in December, right before the year ended to get the 80% bonus depreciation. And then we own some straight out self-storage as well. And then we've done a little bit of build to rent, ground up development as well. And from the private debt note side, there's a company called Dr. Doc Lending, which only lends to physicians and dentists. I'm on the advisory board of that company. And so we have done a note round with them multiple times just for passive income. There's no equity on this side, though we did on the angel side, we did invest in them on the angel equity side as well. Like I said, we like some of the commodity spaces that you can do value add. So this hemp processor is actually a tenant in one of the buildings I showed you. That's how we found them. We had made some other investments in the hemp space, so we kind of knew that they were pretty good operators. We talked about Dr. Doc Lending, so we're on the debt and equity side of them. This is interesting because we essentially created a real estate deal out of this. So we generate cash flow every quarter from them, plus we have equity upside as well. So I was able to kind of put those two together within Vernonville to allow investors to have upside appreciation while getting some cash flow in the process. And this is just a venture fund. We don't have to spend any time on that. And so that's kind of me from a historical standpoint in terms of the assets that we have had over time. And it gives you a sense, and there's more than that. It's a selected subsection. I do sit on the advisory board of a number of companies as well. Helped to found a local bank here that recently opened. So I've got a pretty large kind of investment portfolio as it relates to either my personal portfolio or what we've done with investors as well. So I've seen a lot of the economy. I see a lot of the economy in terms of what we own. So I think that's a decent kind of background in terms of kind of what I see in and around Vernonville. And I guess we can just go from there into the discussion.
Yeah, that sounds good. I had some questions prepared, or if you had like topics that you wanted to specifically get into.
No. I think your topics, your questions that you had were perfect. I think we can go through those and we can expound on them.
Okay, sounds good. Yeah, just to start, I guess, like what was the order in which you started exploring these different asset classes, and what motivated you to go from one asset class to then adding the next, whether it's, the need for cash flow, appreciation, tax benefits, something else?
Yep, absolutely. So the beginning of what I showed you was almost in exact chronology in terms of how we rolled out. And so this journey really started for me kind of in college. I went to Morehouse College in Atlanta. And my college roommate and I, my senior year, we lived in these townhomes just south of the city, and there were 10 of them, and literally it had no vacancy. As one student was moving out, the next one was lined up to move in because they were relatively inexpensive, but they had a great floor plan and layout, and this owner was just basically cashing checks. And we sat there and we tried to figure out how would we buy this? Like, what would this look like? What are the numbers behind this, right? Now, we were both biology majors. I went on to go to medical school and business school. He went on to go to Columbia Business School. Interestingly enough, he's doing real estate construction and real estate in Atlanta. I'm doing what I do. So we ended up converging back on the discussions that we had. But when I went to business school, I was at Rice University in 2000. And at that time, there was a very big energy company here they called Super Innovative, and they were the hottest kid on the block, and Wall Street loved them, and their stock price was going up. And, I'm a biology major. I did 2 years of med school, then went to business school. I had never taken a financial accounting course in my life. And so during that first financial accounting course, it was August, September, October of 2020. We did this particular company's books, and they had a negative operating income from their core operations for 3 consecutive years. So 97, 98, 99, they had made no money from core operations. I'll never forget the professor in his Indian accent circled both of these and said, the IRS would consider this company a hobby. And that company's stock price continued to climb for the next almost year before it completely collapsed. And for those of you who are old enough, you will remember this was Enron. And they recruited heavily from Rice during that time. So I got to interact with those guys a lot. And they were very, very smart people. But when you know how to kind of unroof numbers, the numbers will tell you the story. You don't have to have people talk to you. Just have them show you the numbers. The numbers will tell you the story from that standpoint. And so at that point, I had some small mutual funds at the time. So I sold all that. This was, summer of 98, 99. I sold all my stocks, and I and I used business school as a way to figure out how I was going to invest my own money. That's literally why I was in business school. And what I tried to figure out was, how do people become independently wealthy quickly, right? And that's usually one of two ways. One, a non-service based business, or two, real estate. And so I knew I wanted to practice medicine. I didn't really want to go into medical management. I wanted to at least practice. And so that left real estate for me as the way to invest. And so because I don't invest in the stock market per se, and there's a bit of a asterisk and caveat, meaning we've been part of some SPACs, so we've taken companies public that I own the stock of. But in terms of buying mutual funds and all those kind of things, I don't buy retail stocks, right? I just don't do that. So I had to figure out a way to invest my own capital. So I bought the condo I was in medical school, rented that out when I was in residency to it was a 2-bedroom, 1-bath condo, which I still own to this day. My mother-in-law lives in it. And we just built a portfolio of single families and then small multifamily. And then I pivoted to larger multifamily. So this is 2008, 9, 10, 11, 12. We're buying all these houses. 12, we buy the small apartment complex roughly, turn that around, get a profit on that, roll that profit into a large apartment complex about 2015. And in between that, we were looking at the international project. So we started doing a small bit down in Belize. And so that was a natural progression. Got into the larger multifamily deal. It ended up being much more unwieldy than I expected it to be. We got through it. We made a little bit of money on it. But one of my partners, because I spent a lot of time on the personal development circuit. I go to conferences because that's where I learn. That's how I learn the different asset classes. That's where I meet people. I meet potential partners. And there was a guy who literally lived 3 miles away from me in Houston. We were going to the same conferences. We're like, hey, man, why don't we do a deal together? I was like, hey, man, why not? And he's like, and he had owned about 18 apartment complexes. While I was buying single family, he was buying multifamily in Houston. And he had sold all of them and was like, come on over to the commercial side, my friend. The water's much nicer over here. It's a lot less headache over here. And I was like, really? He's like, come on, come. And so I literally got dragged out of kind of the residential space into the commercial space, and the timing ended up being kind of perfect because of 2018, nobody was really thinking about contractor garages and light industrial projects. Retail was still mostly, and it still is to this day, mostly institutional, but there wasn't a mad rush into it at that point in time. And so we were able to get very good pricing from that. So it ended up being a natural evolution of single family, multifamily, commercial, which is ultimately most real estate people, once they go beyond multifamily, they end up in commercial as well. So it ends up being a natural evolution of a decrease in intensity of management, but it also decrease in intensity of emotion. And what do I mean by that? The buyers and sellers of large commercial projects are institutions. There's no emotion behind it. They know they have to leave some meat on the bone for the next buyer. They're not trying to skin every last dollar off of it. So the negotiations tend to be a little less, we'll just say, emotion filled, right? The other thing is there's just not a ton of people out there teaching how you get into commercial, whereas everybody, especially in Texas, there were lots of great places to learn how to buy multifamily, right? Yeah. And so a lot of it was just a pivot out of a crowded trade. I just felt that multifamily was a crowded trade post 2015, 17, 18, because things I was buying for 18, 19 a door, they were then selling for 50 a door. And I'm like, this is Class C in the hood. What the hell is going on? So for me, the valuation just didn't, back to the numbers, I couldn't wrap my head around it from that particular standpoint. So that's a long-winded answer to say I was pulled into it, but it was a natural progression because I had done so many other things in real estate. I was like, okay, where do we ultimately want to live, and where can we transact regularly that we're not going to have deal flow issues, and ultimately there's a lot less emotion around the numbers, because when you're dealing with other business people, they realize these people need to make a profit as well. Don't try to cut every dollar on the sales price.
And where does the other two asset classes, private loans, and three private loans, angel investing, and commodities, where does that fit into that real estate timeline?
Yeah, so the commodities I haven't broached heavily. We just off air, we were talking about the oil and gas thing. I haven't broached that heavily yet. And so for me, owning the coffee plantation, that's actually still just a real estate play. It's just, think of it like a timber play or anything like that. except for my tenants are berries and we harvest them and we sell them, right?
Yeah.
And so I consider that really more of a real estate play, and because it's specialty coffee, it trades at a much higher value add component than the coffee you would see on the ticker symbol, right? It's a much higher multiple of sale from that standpoint. The debt notes was just another way to create cash flow for investors. And so I have a lot of physician investors. A lot of them are looking for ways to not work quite as much clinically. Most people don't want to get completely out. They want to get probably, 1/3 to 1/4 less clinical time without taking a hit financially. And so we were looking at private debt from the standpoint of anything that was above market rates. So when we started this, 10-year treasury was at 0.91, 1.1%. And so we were offering 5.5 to 7% back in 2020-ish. And so from that standpoint, my big thing is you just want to beat the rate of inflation, right? As long as your money can beat the rate of inflation, you are building wealth.
Yeah.
And so it was just another quiver when we didn't have real estate deals going for our investors to be able to be in a very solid, because all of these are backed by loans to physicians and dentists. That group has a less than 0.5% default rate on the money. So as long as a loan is made, there's a very high likelihood that loan is going to get paid back. So it's actually one of the safest investments we could make. And for those of you who are kind of Sharpe ratio nerds and those kind of things, the Sharpe ratio for that kind of investment is way better than almost anything you're going to find in the equity markets, even talking about venture from that standpoint. So it was just another diversified asset class that people could generate income, because we don't raise an individual real estate fund. We raise per project. We just don't have money sitting around. So it's like, okay, there will be times where we might do one big real estate deal a year or two. So during COVID, we did nothing, right? 2020, I don't think we did any real estate deals, but we did a bunch of the loans, right? We probably put a couple $1 million on the debt side. So our investors were still able to create great cash flow while, even though we didn't have real estate deals to put them in at the time.
Cool. So out of those four asset classes, real estate, private debt, venture capital, and whether you want to call the coffee, real estate or commodities, that's up to you. How, if you're open to it, how does your portfolio break down, right? Like X percentage, or if not percentage, then just number 1, 2, 3.
Yeah. So the commercial real estate by far, as you could see, just kind of the rollout, right? Commercial real estate by far is the biggest portion of it. It's just, they're institutional grade assets. We have more than enough to be a REIT if we wanted to. That's the bulk. I would say next would probably be the private debt would be the next biggest tranche of kind of where the portfolio sits. Then would be the angel investments, and most of those, because they're risky. Investors are putting 5 to 10 grand, maybe 15 grand into them. They're not big. Like, I'm big on portfolio construction and asset allocation. So while we have investors who will put 250 into a real estate deal, there's no way in heck I'm taking 250 from them on one of the angel investments, right? It's not gonna happen, right? Now on our venture fund, you can, because we've got 20 companies in the fund, you'll be fine, because the law of math and averages of venture make it make sense. But when we're doing one-off angel deals, nah, you're gonna be in for 10. The most I probably allow anybody to put in was 25 at most, right? It was just too risky. So a lot of it stacks out about position sizing, right? So the real estate deals have much bigger position sizings. So by de facto, we're going to have a much larger plot of that from that particular standpoint. And everything else, if you look at it, the way I try to create Vernonville, because again, this is how I invest my own money. I had to create a diversified pie of asset classes, right? And so in many ways, we structure it by, back to Sharpe ratios, back to alpha, kind of, where is the risk, right? Where's the biggest risk? Well, clearly the lowest risk is going to be in our debt portfolio, right? Without question. But the upside is capped, right? There's no upside. You're just going to get your regular capital back and you'll make, well, now it's up to 10%, but that's a different discussion. But we're writing it, you're making 5 to 7% a year. Now, that is cool. Don't get me wrong. But there's no upside on it. You're beating inflation, but there's no upside, right? And so the beauty of the real estate was we could do that easily on a cash-on-cash return, plus some equity upside. Now you're taking a little bit more risk from that particular standpoint. But all in all, it's the risk benefit ratio is way higher, right? And so that's kind of how we looked at it. The commodity one, that really was the coffee was really an evergreen play, because it's been a farm, it's going to forever be a farm. So it's one of those things where you're going to pass that down over time. Don't know how much you follow coffee, but right now we're at the lowest level of coffee production ever kind of in history. In terms of coffee stores, all those are being brought down. If you look at climate change, it's affecting, and I could nerd out to you on coffee and kind of where the best coffee grows and why climate change is going to cause an issue, which is why we wanted to buy the land as soon as we could and own it, because we think in 20, 25, 30 years, it's going to be much more valuable from that standpoint. And so if you looked at it from a pie chart, it's heavy, the commercial real estate. Next would be the debt. The angel is very small. I think we have like 3 or 4 angel deals completely. And then the venture, though it's a different company, we have a lot more over in the venture side too for people. But same thing. Our venture units are $11,000. Same issue, same thought process. You can buy multiple of them, but we make it low enough that people can begin to dip their toe into the asset class, because I would say the problem with real estate, though you do have equity upside, is you can only rent time for so long. So there's no exponential growth you're going to get out of real estate. And so I firmly believe that people should have 10% of their portfolio and things that can go 10x on them. And that's why we do kind of the venture angel. That's that very sliver 10% of people's portfolio that we want to be able to have them have access to through us from that standpoint.
Yeah. Yeah, it's definitely one of my missions too. Like we were talking about, I just invested into the first oil and gas syndication. I don't want my portfolio to just be 100%, commercial real estate either. And I've been interested in private lending as well, both short-term debt, maybe like, 3 to 9 months anywhere, but then maybe some longer term debt as well. And then small businesses too, right? Like a lot of Gen X, I think that's the right generation. Gen X folks are retiring. Their kids don't want the businesses. So,
Oh, no, that's baby boomers. I'm Gen X. We still got another 20 years or so. Oh, yeah. No, no. The baby boomers, those are the ones retiring.
Yeah. So baby boomers retiring. And yeah, their kids don't want the businesses. And then a lot of them are ripe for, disruption, where you just integrate some tech or, what have you, and, you got a golden goose on your hands. So for someone
we're actually going to be looking at more private. So we would consider that private equity. So we're looking at more of that probably this year. Actually, I was just on a call earlier with someone who's got a product that we're looking at. We just got to figure out the valuation he wants to get for some shares. So yeah, I think private equity is another great asset class, management intensive. So there's some risk there, but it's another portion you want to have in your portfolio as well.
And these asset classes that you mentioned, right, and even private equity that's coming up on your roadmap, which one of those, investments do you actively manage, and which one of those are you simply a capital partner in?
Ooh, so all right, I set my whole life up to not have to actively manage anything, because while I can do management, I hate it. And what I mean by that is the repetitive nature of management. So that's the thing that's why private equity has been the last thing to go into, because I will have, while I am on the board, I can be pretty much advisor on most of the boards I'm on. Once we get into private equity, I'm likely having weekly meetings, bi-weekly meetings with CEOs, chief operating officers. I'm putting those people in. That's going to take up a little bit more of my time. And so the good thing is we've structured everything else in such a way that is relatively passive. And so the PE will be the most active thing. The other investments, so I have GP partners on all that commercial real estate. I mean, we go out and smoke a cigar together, sit around, talk, we'll get back and forth. But I purposely have operations partners I'm willing to give up equity, because that's what they do. My partners are literally full-time in real estate, one of the top commercial real estate brokers in the city of Houston. Like, this is what he does every day. Another partner is a top real estate attorney here, right? And so I'm happy to bring in teams of partners that what they do is the operations piece, right? And real estate, again, especially at triple net commercial real estate, is relatively passive once you put a good management team in place and a good leasing team in place. We've got a good leasing team in place, and management is really facades, roofs, and keeping the place clean, and that's relatively fungible from that standpoint. So there's not a lot of operational headaches around that outside of the lease structures. But again, that's my partners take care of because that's why I decided to partner with them. On the private equity side, that'll be me, much more operationally focused. And so right now, I would say I probably spend 5 to 10 hours a month thinking about these things. So either having phone calls, making Rolodex connections, because that's the one thing that I'm pretty good at is I have a very extensive Rolodex. And so I know people who do stuff. So people who need things, I'm like, oh, I got somebody for that. And I just make those connections, right? From that standpoint. And so I'm not one who tries to be an expert in everything. Like I said, I'm a general internist. I know a little bit about a lot. Same thing in business. I mean, I can read a balance sheet, right? So that's probably the biggest thing. But I know a little bit about a lot. So from a marketing standpoint, I need, lifetime value of the customer. I know CACs. I understand all that stuff, right? I'm not going to run your social media campaign, right? I know the people who will do that, but I know how to manage those people. So I know what reports to get. So it doesn't take me a lot of time because I know what metrics it is I want to look at for all of these different industries. And I guess that's probably the biggest thing I can give your listeners is understand the levers in your particular industry. And it gives you a very shortcut. Understand the revenue levers, understand the expense levers and who controls them and what are the most important things around them. And then you can figure out if the management team that's talking to you knows what they're talking about and can actually execute on
them. Okay, that makes sense. For people who are just, beginning to construct their portfolio, like you did years ago, let's say they've just been investing into, mutual funds, ETFs, whatever, et cetera. Walk us through like what you would recommend for them as like an action plan, I guess. Like how would you get started building a portfolio?
Oh, so we can damn. I think I can pull it up. There's a great slide in that deck that I sent you that I always do the presentation on. So you need at least 40% of your portfolio outside of the public markets to get your highest returns and have your lowest volatility/risk. And people don't realize that. So if you are wildly overweighted to the public markets, you are taking on too much risk and will not make enough return for what your ideal and optimal portfolio would look like. So at least 30%, probably up to 50% of your portfolio needs to be in private assets. You can choose what kind of asset class you want to be in, and that's going to be a function of who you have access to and what sectors are in favor at that particular point in time, and then also what you're trying to accomplish with your portfolio. So we just start with the baseline that 30% of your portfolio needs to be not in the public markets. So not in stocks, bonds, and mutual funds. So now the next question you have to ask yourself is, okay, cool. I need to diversify and be truly diversified. What does that look like? So now that it comes to what are you trying to accomplish? So if you're trying to generate secondary income, okay, so now that can be fixed income, that can be private lending, private debt, that can be cash flowing real estate, that can be oil and gas assets, whatever the case may be, right? So the first thing is what are you trying to ultimately accomplish with your portfolio? So that's where you start with because it's your money. The next thing is who do you have access to, right? Because you can go on a crowdfunding site and pour a bunch of money in, but you don't know who any of these people are. You don't know what their track record necessarily is. You don't necessarily get to speak to them one-on-one. You can't get through their head and how they think about downturns and mitigation. And did they invest through the great financial crisis? Did they invest through this massive increase in interest rates? Like, who are these people, right? So can you get close proximity access to people who are doing these kinds of asset classes and investing in them so that you can get comfortable and they can teach you what are those levers that I was talking about in terms of how do you do these types of assets and invest in them in an effective way, right? I always tell people, I make the joke that even if you just watch one of my investor presentations, you will know more about that asset class than you probably know about your own personal portfolio if you're just buying mutual funds from that standpoint. Because if I ask most people right now, what is the cyclically adjusted price to earnings ratio of the S&P 500 right now, and what does that mean for future value? 99 people out of 100 don't know what I'm asking, right?
Yeah.
If I said, hey, can you do this kind of cash flow analysis on, you love the FANG stocks, right? You love the Magnificent 13. What's a DCF on Google right now? And what should be their imputed stock value based upon where they sit right now in terms of their earnings, right? If you can't do that, you really don't know what you're invested in, right? The beauty of multifamily is, here's the cash flow. Here's what we're buying it for. This is the valuation metric. Okay, Revenues are here, expenses are here. This is how we get a return. Very simple. It's relatively simple for stocks as well, but people don't know how to do it, right? But it's all the same kind of number crunching. And so what I hate is when people try to assume that because the stock market is more liquid, that it's less risky. It's literally mathematically not less risky. Like I can give you the data, I can show you the charts. From that standpoint, it just more people are just willing to give the faith to the stock market than they are to say, okay, I need to watch an hour presentation to understand something a little bit different. And so what I would say is people just need to start with, I've got to take action and allocate away from being wholly 401k centric. That's first step. Next step is begin to talk to people who do this full time for a living, who understand this, who have a track record, and learn why it is they're doing that as opposed to doing something else. Because I can give a whole roadmap, but the first action step is the most important step. So all I need to do is people to get to the pre-contemplative phase of, oh, this is something I think I want to do. Let me pick up the phone and call Hishev. Let me pick up the phone and call these people and have a conversation about what the heck, what's really going on. Why are you doing this kind of thing to get a much better understanding?
Okay. And one of the things you mentioned was, the stock market is, mathematically riskier than other investments. In addition to Sharpe's ratio, what other data or, like models do you use or mental frameworks to assess risk in investments?
So for me, it's, well, here's the thing. Well, so it's two different things, right? So you have systemic, then you have individualized, right? And so the way you can get rid of the systemic is by doing the mutual funds, right? So they got that right. The problem that people don't understand in the public markets is your ultimate return is directly correlated to the price that you're paying for the asset. And it's the same in most asset classes, right? Same thing with multifamily, right? If you're buying the top of the market, in commercial, you're buying the top of the market, the chances of you getting a better return than somebody buying at the bottom of the market is just not there. And the problem is because people have been conditioned to the dollar cost average, which again, that's fine for your portfolio, but if you're trying to optimize, if you are buying an asset that is overpriced, and so to the metrics I look at is cyclically adjusted price to earnings ratio, right? It's a 10-year look back over kind of historical norms of the price to earnings ratio. And then there's another graph that you can look at in terms of historically, when you're buying at these ratios, what has been the historical returns for those assets out into the future, right? So you bring those two things together. There's also something called the Buffett ratio, which looks at kind of the total market earnings over GDP. And it comes out exactly almost the same as a cyclically adjusted price to earnings ratio, right? They almost line up 1-to-1. And it's an easy graph. If you're above the zero line, it's expensive. The higher up you are, the more expensive it is. If you're below it, it's cheap. And so if you're buying stuff in the fair value range, you'll probably do okay. If you're buying stuff in the expensive range, over the next 10-year period, you're probably going to be between -3 and 3 to 5%, right? And so once you understand those mathematical models, you can just Google those numbers in terms of where you are. Now, if you're talking about individual stocks, we don't have time for that. That's a much longer conversation. Depends on the asset class, depends on all kinds of stuff. So, but I would just say most people are in low cost mutual funds, index funds. What you need to look at is the historical Tait ratios and where do we find ourselves today, right? And I will tell you this, we find ourselves at 32, 33, 34 plus. And what's even more scary is it's literally only 7 stocks that have caused all that run up. It's all the FANG stocks. And if you go to 13, 70% of all the returns come from 13 stocks. So the S&P 500, like 480 something of them are negative or expected to be negative, or earnings are going to be down. And it's only those big blue chip tech companies that are driving all the returns. So now you've got a super narrow window of these particular companies that are driving all of your returns because of the way they weight the construction of index portfolios. And so if you end up having a stumble, all the market could stumble because these 7 or 13 names have an earnings miss or there's an issue. So you have a massive amount of concentration risk when you think you're diversified because you've got all 500 of the S&P, not realizing that those indexes are weighted by market cap. And all those companies have super high market caps now. So they're overweighted for those companies. And it ends up being a self-fulfilling prophecy because the more those companies are successful, the more money flows into them, the higher their weighting is, the more your portfolio could have an issue if those companies stumble. And it's just a vicious cycle over and over and over again right now.
Now, how about for the sectors that we care more about, the private sectors, like real estate or private?
That's easy, right? The beauty. I tell people the secret to real estate, you're only solving for two numbers, right? In real estate, because most things are plug, right? Market rents is a plug number, right? You can assume you're going to get better than market rents, but I wouldn't do that if I were you in a pro forma. You can assume that you can get cheaper insurance than anybody else, but I wouldn't assume that. You can assume that you can get your taxes lower than everybody else, but I wouldn't assume that either, right? Market occupancy, you might be magical and be able to get better than market occupancy. Maybe, maybe not. But just plug the average, just plug the market in, right? All those things, if you know you're going to buy at this, you know what the property taxes are going to be. You know what the insurance is going to be, right? You plug all those numbers in, you're going to get a cash flow at the bottom. Possibly. If you're not getting a cash flow at the bottom, it means that you need to negotiate a better price. That's all we're really figuring out, right? Is what do we want to make? And that's directly proportional to how much we're paying. You get a lower price, everything else falls through that waterfall the same, right? So we're only saying, what do we want to make? And what price do we have to pay to make what it is we want to make? Because we'll just assume that we're going to be average in terms of running the property. And that's the beauty of real estate, is you don't have to keep buying. You just stop. Like I said, we didn't buy anything in 2020 because the prices were all off. We bought 3 shopping centers last year. No, well, 2 shopping centers, 3 warehouses, and then a big portfolio. But the portfolio was worked on in 2022, so I don't really count that. But it was what we'd say is a relatively slow year for what we could have done, because sellers still wanted 2021 pricing, not understanding that cap rates had to go down because interest were up, right? Yep. So you have to wait for the market to lag itself out and figure it out. We have a buy box, right? Every asset class has a buy box. If it has this cap rate with X amount of occupancy lift and rent lift, we're gonna put an offer on that. If it doesn't fit that, we'll just sit here and collect our money from what we already have. We don't have to do deals, which is one of the reasons why I don't put a fund together. Though it would be easier just to put a fund together, you would still have that IRR clock ticking that you have to go buy. And that's where people's buy box slippage can occur, when you've got money and you've got to put it to use. And so while it's much more painful to raise per project, it enforces another set of discipline in that we're going to go through all this rigmarole, me and my partners, because they're raising capital from their people, we're putting it all together. If we're going to do all that rodeo, this deal better make sense, because there's no point in us at the last minute backing out. Something that it really needs to make sense from that particular standpoint. And so the only metric I'm looking for is, well, on the cash flowing stuff that we tend to buy, which is the bulk of the portfolio, does it cash flow at the rate we want to cash flow, with everything else being equal, and we just hit average market metrics, right? If it does, we'll buy it, because especially today with interest rates where they are, we know in 3 years we're going to be able to refinance it to a lower interest rate. And what's going to happen to the cash flow and the value? All of it's going to expand again. But even if that does not happen, we're perfectly fine making the return that we would make just holding it in today's environment. Even if we didn't have to raise any rents, right? And the beauty of commercial rents are that they already have imputed increases in them. So we have to go back and negotiate with the tenant. The tenant's already signed that lease, right? Yep. So we know the value of the property is going to be higher unless interest rates just shoot up again. We know the value of the property will be higher 3 to 5 years from now, just because of the internal rents that have to go, rent escalations that are in there. And if we know that interest rates are starting to creep their way down, if we buy that today, we're pretty sure rates are going to be lower 3 to 5 years from now. Now, something strange could happen, but if it's not, it's fine, right? But we're pretty sure we have indications, right? The federal deficit is so high, we're going to pay $1 trillion in interest payments next year, which is going to cripple the budget, which means the Fed really can't keep rates much higher for much longer. But we won't go into that macroeconomic analysis, right?
That's so there's right there.
That's right. It's a whole webinar right there. So there's a natural break point for how far the Fed can really push this and not bankrupt the U.S. government, right? And that's a thing that's hanging in the background for folks who are macro kind of watchers. So all of that to say, if it cash flows today with the average occupancy and average everything else, those are the metrics we look at.
Yeah. A lot of people I talk to who are in the stock market, they think, getting out of there into one of these investments is really complex and you have to figure out how the business works and all that, it's like you said, it's really simple. As long as you're able to read a few key numbers and obviously invest with the right people, then you'll be golden.
Yep. People don't realize that this kind of cash flow analysis is way more complicated than whatever we do in real estate in terms of performance.
Yeah. So given where we are today, right, like two conflicts, and obviously abroad, like internationally, a bunch of elections coming up globally. I think like 40% of the world's going to vote this year. And here at home, bunch of opportunity coming up with multifamily real estate loans in distress, commercial like office loans in distress. What would you recommend for people who are building their portfolio? Again, outside the stock market.
Yeah. So
And
there's
interest
just
potentially
understand
coming
that the
down
news
also.
is there. Yeah, I don't think they're going to cut rates till much later in the year.
Yeah.
So for those who are have to bank on that, I think that's going to be a little bit problematic. But the news's job is to get an emotional reaction from you. Okay. So while the world feels like it's on fire and worse than it's ever been, we're actually at a stage where in human history where there is less conflict in the world, there are less people dying, life expectancy is going up. Like they're all like all human indicators. I'm not just talking about in the West, I'm talking about globally, are pointing in the right direction, are going up, right? It doesn't feel like that because 30 years ago, you weren't getting the news from Kosovo as to the bombing of this church and this house, right? The internet's been a gift and a curse. The curse is that the business model of eyeballs and attention require conflict, right? But if we talk about the real, US GDP last year was over 3%. Specifically in the fourth quarter was like almost 4%, right? It may get revised down, but we're growing faster than any other economy on the planet, right? Right now. And we don't even have any immigration policy going, right? So if we figure out how to integrate these people, it's going to grow even faster. So just take it from that standpoint. So we've got two wars. The war, the Russia-Ukraine proxy war that we're running, really is not going to touch us from that standpoint because from a strategic standpoint, Russia's a pariah state currently, so their effects on the global markets for what we're doing on the oil side is something that can really touch us. Not that big of a deal. With the Middle East conflict a little bit closer to home, with Iran-backed militia out of Baghdad killing those 3 soldiers, but you saw very quickly that militia was like, oh, our bad, we're not going to be targeting U.S. people anymore because they know they're about to get wiped off the face of the planet with that. And the issue is because Iran basically controls the Strait of Hormuz, which is 1/5 of all the barrels of oil that is used today goes across that strait. A Middle East war, if Iran were to close that, would cause a massive global upheaval. Iran, everybody is back down since those 3 soldiers were killed. Nobody wants a hot war with the United States. And so I am less worried about that because Iran it will push to a certain level, but they know when they know when they've taken it too far, and they know that they've taken it a little too far right now. So I expect Iranian and U.S. tensions to die down. Those are the only tensions I really worry about in the Middle East because Iran can close that Strait of Hormuz. Saudi Arabia is going to do what Saudi Arabia does, but because the U.S. is now the world's largest oil producer, OPEC is trying to cut, but the U.S. is like, we don't care, 13 million barrels a day, boom, right? And so the U.S. has become wildly efficient, and so it is frustrating OPEC because we now have been able to more efficiently exploit our oil reserves and natural gas reserves here in the United States, right?
Yep.
And so a lot of that stuff we're hearing is going to be blunted. You just saw the jobs report. The jobs report was nobody expected it to be that way, right? I mean, the only downside of all this good news is it might not let inflation go down, which is going to allow the Fed to keep rates higher longer. So that's why I say you've got to undo what you hear in the news and go to the real data and the actual data of what's happening. And the actual data of what's happening is, yes, prices are higher than we would like them to be, but they're not rising as fast. They're stuck high and they're not going to probably come down, but they're not rising as much as they had been. Other than that, the job and labor market is pretty strong. And so, if you're in the Sun Belt, if you're in places in the United States where people are moving, So Southern Virginia all the way to Arizona, and you're investing, you're probably going to be okay. Just make sure the deal's cash flow in the current environment, and you don't have to hit. If you're buying an existing deal that you want to cash flow, you're not building one to cash flow, but it's already there. You're just going to do a little minor things. I would say the way to be safe right now is to make sure your deals cash flow out the gate, and then you're optimizing up. Not that you have to go and do something, meaning, and I don't mean you're building from ground up. Ground up development's a different discussion. But you're buying something that's 80% occupied, but it's not cash flowing at 80. You've got to get it to 90 occupied. Get the price down. Get it to cash flow at 80 as a safety margin, and then go from there. That's the advice I would give.
Okay. And I guess how about specifically with the distressed loans that are coming about in real estate, U.S. real estate?
So are you talking about going in with preferred equity to help some of this stuff, or
your general recommendation?
Buy loan notes?
General recommendation to investors.
For the average investor, they don't have experience, they need to stay away from that, or they need to get with a syndicator who knows how to play in that market, because there are a lot of loan covenants that may have been breached. And if you're not working directly with the lender to find out if there have been technical defaults, what it's going to take to cure those technical defaults, I wouldn't blindly give a syndicator new, fresh equity without a clear understanding of what the lender signed off on, if they're willing to take, if they're willing to do, what that equity is going to be used for. If the equity is being used to refinance the property and it's going to be stabilized after that, I think that's a fair deal. If the equity is going to be used just to maintain operations, I think that's might be throwing good money after bad. So you have to be very clear on what's being asked for in these distressed situations, because not all syndicators are made equally, and not all situations are easily remedied just by a decrease in interest rates. If that makes sense.
That makes sense. Yeah. What do you see like for, I guess, this year and next, the hottest asset classes that you're personally looking into?
Yeah. So, I mean, we're not off. Well, so we're still going to be retail, light industrial, heavy, if we can find it, because with all of the inflation and increase in materials and labor, nobody's building any of these things. So you're having nobody's building them on spec. And so when you have places like Texas where, I don't know, 500,000 people are moving a year, and nobody's building spec retail, but you're building, so home builders are building houses as fast as they can, but nobody's putting in the retail and those kinds of things. The existing retail, and especially the existing retail in infill locations, becomes much more valuable, right? So you have cities that are becoming urbanized, like, so the Southwest, the Southeast are becoming urbanized. You're going vertical now, right? So you're in city centers that are going vertical. So you have more rooftops in these buildings, but no more retail to fill into those rooftops. And so that's why we like the retail space. Same thing kind of in the contractor garages, like industrial. Those are just C-class commercial, right? It's just C-class, triple net commercial properties, right? And so when you leave your job, you want to start a business, and you're getting out of your garage, that's the place you go. And if you're in cities that have high immigration, right? So Texas, specifically Houston, most diverse city in the country, the immigrant groups that are coming are all entrepreneurial groups. And so they're wanting to start businesses, right? They're hitting the first rung of the American dream. They need a place to put their lawnmower. They need a place to put their plumbing supplies. They need a place to put their HVAC equipment. They have a place to put their ambulances. Like, they just need those kinds of places. So this is the first rung up of kind of mom and pop businesses to get their first shot at the American dream. And nobody's really building those either. Most of those got built in the 70s. So as the United States becomes more entrepreneurial and less corporate, because everybody's their own kind of independent entrepreneur these days, if you're selling physical products, you need a place to put these things. And between self-storage and the contracted garages, if you want a showroom, that's where these small businesses for $1,200, $1,100 a month, $1,800 a month, $2,000 a month can have 4 walls, AC, and a bathroom, and roll up door to get inventory in and out from that standpoint. So we're really bullish on that. I've never done office. So the things we've never done: short-term rentals, office, and heavy industrial. And the reasons why heavy industrial is usually single source. So you go dark, you're out of here. Office has always been bad in Houston. So I don't know about other markets. So I personally just didn't touch it. I don't know anybody who makes real money in it. And this was before worrying about COVID and before worrying about complete AIing and SaaS models and just workforce downsizing from that particular standpoint. So those are asset classes I can't wrap my head around the dynamics because the end user is so in flux. I stay away from those kinds of that kind of uncertainty.
Gotcha. Okay. I guess to take us out, what is, I guess, like from your personal experience, one of the biggest mistakes or like roadblocks that you ran into when you were building your portfolios over all these years?
Fear, I should have gone bigger, faster. So fear, not taking action. For me, I'm actually an action taker. I just didn't take big enough action. I think for most investors, taking the first action, even if it's small, is the biggest thing I always try to get forward to people. The other thing is it's a little secret that most people don't know they'd like to get out there is the fear of loss. I get it in terms of these private kind of projects, but the secret and why the wealthy play in this space so much is as long as you stay in the game, there's never really a loss outside of opportunity cost. So let's say you get into a deal where you put 50,000 or 100,000 in, it goes bankrupt, it goes belly up, it's bad. You now have a 50,000 or $100,000 capital loss on your tax return, right? Well, if all you do is go back into the stock market, you can take what, 3,500 of that capital loss against your income a year at best, right? Same thing in the stock market. If you lose in the stock market, 3,500 years all you can take. But if you invest in another, and again, I'm not an accountant, talk to your own accountant for your own things, but if you then go into another, let's just say apartment deal or something like that, and it hits, you put 100 in, and you double your money, you get 200 out, right? Well, you still have that 100 loss on the other side, and that 100 loss will offset the gain, so you're not paying the taxes on that. So that 100 loss, so that what you would have owed, you owe less of, and you can roll forward those losses as long as you stay in the private sector and as long as you stay in the private investing side of the world. And so that is the biggest secret of why the wealthy pretty much only play in this space. Because even when you lose, if you're winning on another deal, that loss gets offset by the win. So the only way you lose in this is to stop playing the game. If you stop playing and you run back to the stock market after you have a loss, you'll never make it up. You'll just never make it up because they won't allow you to use it against stock market gains in that way. So stay in the game, get in the game, and stay in the game is what I tell most investors.
Gotcha. Okay. Well, I guess that did a good job of my next question was going to be what would be your number one advice, but that sounds like that's your number one advice to invest. Okay.
Take action is my number one advice always, because most people do analysis paralysis. They get B-type personality, they get scared, they won't take it like somehow. And again, I'm not flippant with money, but money is not talismanic to me, right? Especially my own personal portfolio. I take bigger risk in my own portfolio than I do ever with investors. But again, it's not talismanic. And especially for high income earners, we can always make more money, right? Yeah. The question is, are we getting into assets that can change the quality of our life? A 401k never changed the quality of my life today. It might in the future, assuming I live long enough to collect it. Me owning real estate made it so that I don't have to get up and go to work every day, right? The quality of my life is demonstrably better because I allocated my resources for specific asset classes that allowed me time freedom and personal freedom. Yeah. I wish that on everyone.
Yeah, that's the goal.
That's the goal.
Okay. Well, with that concludes our webinar today for building a diversified portfolio of investments with Dr. Eric Tait. Eric, thank you so much for taking time to speak with our audience. And We'll send you the link for this recording and the podcast episodes as well, so that you can distribute it with your audience. And
Thank you.
would love to have you on for a future show.